Hello, I'm Julie Price and welcome to Juniper's Economic and Market Review as of September 30th, 2023. Thank you very much for joining me. Resilience seems to be the most apt description of the U.S. economy this year. In fact, the Atlanta Fed is calling for an acceleration in growth during the third quarter. At the same time, inflation has continued to moderate, helping to spark enthusiasm for a soft landing. A soft landing is when the Fed raises interest rates enough to slow the economy, but not so much that it causes a recession. However, with tailwinds from consumer and business spending likely to fade in the coming months, the path to a soft landing may be narrower than expected. And as Dr. David Kelly of JP Morgan says, diamonds are forever, but soft landings aren't. Meanwhile, reaccelerating growth and a still tight labor market have complicated things for the Federal Reserve as they continue to balance the risks of over versus under tightening. At its September meeting, the Fed kept rates unchanged at 5.25% to 5.5%, but forward guidance left the door open for another hike. Nonetheless, the Fed does seem to be near the end of tightening, and the pace of cuts next year will be largely dependent on whether or not the U.S. economy falls into a recession. Even considering the twists and turns of the year, many sectors of the market have posted solid gains year to date, and volatility has been relatively benign. Current valuations, while still below 2021 levels, may look more expensive and require prudent security selection. When building portfolios, the questions for investors are which asset classes are offering attractive entry points and which areas to overweight or underweight in a very complicated macro environment. In this quarter's video, we assessed the performance of this past year for markets and the economy, considering trends in growth, jobs, and inflation, and how these trends are shaping the outlook for monetary policy. This is followed by comments on growth from around the world. Finally, we considered the implications of all this for those investing across asset classes and highlight the importance of taking a balanced view toward asset allocation and actively managing risks within portfolios. Any investment strategy should start with the broad assessment of these fundamental issues. To help us out, we turn to JP Morgan's Guide to the Markets. Join me while I discuss these topics and more. And feel free to pause the video to read the slides as you listen. Economic growth has been impressive this year, and the last quarter has been no exception. Easing inflation and improved prospects for growth have helped fuel optimism for a soft landing. However, a quick look across each sector of the economy tells us that economic momentum is slowing, and we may not be out of the woods just yet. Business spending has held up better than expected, despite tighter lending standards, supported by increased spending on intellectual property with greater emphasis on building and integrating artificial intelligence capabilities. Spending in this category is less interest rate sensitive as it involves paying workers as opposed to making large investments in equipment and structures. Nonetheless, increased caution among lenders and slowing corporate profits could still constrain growth in capital expenditures. Consumers have remained resilient in the third quarter, supported by a tight labor market and rising real wages. However, they have been depleting their savings balances and taking on more debt to maintain their current lifestyles. While revolving credit as a share of disposable income does not yet look overextended, delinquencies are starting to rise. This, along with the lagged impacts of monetary tightening, higher energy prices, and the resumption of student loan payments, should weigh on consumer spending in the coming months. The housing market appears to have stabilized, albeit at low levels, as tight housing supply and steadying mortgage rates are signaling that the worst is behind us. Trade should be a mild drag on the economy due to the lagged impact of a strong dollar and slowing momentum from the global economy. Overall, the U.S. economy should continue to grow at a moderate but slowing pace from here, and while a recession is not guaranteed, a slower moving economy will be increasingly sensitive to shocks. With risks remaining on the horizon, JP Morgan sees at least a 50-50 chance of a recession starting by the end of 2024 and a greater chance of a recession in 2025 if one fails to materialize earlier. The labor market has held up remarkably well throughout this economic cycle, but its strength is gradually easing. The pace of job gains, while still robust, has been trending lower since last year. In fact, the 3-month moving average of payroll job gains fell to its lowest level since the onset of the pandemic in August. Improved labor force participation has supported job growth so far, with the participation rate for adults aged 25 to 54 having fully recovered to pre-pandemic levels. However, while the short-term impacts of the pandemic have now abated, aging demographics continue to place a structural limit on labor supply growth. The participation rate for adults aged 55 and over has remained depressed, reflecting an aging baby boomer population that has permanently left the workforce. Even with higher wages and low unemployment, the labor force participation rate may struggle to move meaningfully higher. Other labor market data suggest a trend of normalization. Weekly initial claims for unemployment have averaged 232,000 in the third quarter, a tick down compared to last quarter, but above its average of 214,000 in 2022. While this level is still indicative of a healthy labor market, claims may begin picking up more rapidly in the months ahead. Employees are also losing some confidence in their job prospects, as shown by recent declines in the Conference Board survey measure that asks individuals if jobs are plentiful versus hard to get. Business surveys are showing similar trends, with the PMI measures of services and manufacturing employment and small business hiring plans moderating in recent months. Overall, the labor market still looks strong, and the risk of recession this year remains low. However, cooling demand for labor suggests that job growth should decelerate in the coming months. A tight labor market has allowed the unemployment rate to hover below its 50-year average despite cooling demand, averaging 3.6% this year despite rising to 3.8% in August. Importantly, cooling labor market conditions have contributed to a moderation in wages, which only grew by 0.2% month over month in August for all private workers. Wage growth has now come down to 4.5% year over year from a peak of 7% in March 2022, and while still above its long-term average, we do not see it contributing significantly to upward pressure on inflation. Instead, workers are being compensated for prior losses in purchasing power after wages failed to keep pace with inflation for most of 2021 and 2022. Importantly, there is also a limit to how much the unemployment rate could rise going forward in the absence of a recession, as U.S. businesses still face structurally slower labor force growth than in prior decades. Diminished legal immigration, particularly over the pandemic, and baby boomers reaching retirement age have left the economy short of workers. Because of this, the unemployment rate may only nudge slightly higher in the year ahead, despite businesses reeling back hiring efforts in the face of slower demand and higher costs. However, wage growth should continue to decelerate and help give the Federal Reserve confidence that inflation is sustainably coming down. After nearly 2 years of hot inflation squeezing consumer wallets and contributing to a swift rise in interest rates, a sustained inflation downtrend is now underway. Headline CPI inflation has come down from a peak of 9.1% year over year last June to 3.7% year over year in August. Importantly, disinflation has been primarily driven by reversals in the major hotspots that drove inflation higher in the last 2 years, and some of those tailwinds may now be fading. In particular, a spike in energy prices caused headline inflation to jump in August. However, oil prices should have a limited impact on CPI moving forward as, absent any shocks, energy prices should abate as we move past hot summer weather and production continues to ramp up. Easing vehicle prices, reflective of improved supply chains, have been a key source of disinflation, however not as consistently as we would like. Shelter inflation, while still the largest contributor to inflation, has also begun to decelerate. Since this measure reflects market conditions with a significant lag, slowing rent growth suggests that this should continue to exert downward pressure on inflation over the next year. The remaining problem for inflation is core services prices outside of housing, Chair Powell's favorite measure when referencing persistent inflation pressures. However, it seems to largely reflect the lagged effect of some of the supply chain issues that impacted core goods, as transportation services account for the bulk of remaining inflation. Improved supply chains, moderating vehicle prices, and easing labor market tightness should allow this measure of inflation to come down over the next year. While inflation may still be above the Fed's 2% target, it is gradually falling to much more manageable levels. CPI inflation is expected to decline to 3% year over year by the end of this year and towards 2% by the end of 2024, even without a U.S. recession. Here is a slide that we've been monitoring for the past year. The National Bureau of Economic Research, or NBER, determines whether or not we are in a recession. In recent decades, the two measures they have put the most weight on are real personal income less transfers and non-farm payroll employments. As you can see, real personal income less transfers has been moderating in the last few months, while non-farm payrolls have declined slightly. Industrial production has improved significantly since last quarter and is up 0.9% over the last 6 months. The Federal Reserve has hiked rates by a cumulative 5.25% over the last year and a half in an effort to accelerate the decline in inflation. At their September meeting, the Fed voted to leave the federal funds rate unchanged at a target range of 5.25% to 5.5%. While this move was widely anticipated, forward guidance was still moderately hawkish and left the door open for a November or December rate hike. Indeed, the Fed's updated dot plot, which is their projection, suggested that they may not be done yet. The median Fed member still expects a year-end federal funds rate of 5.6%, implying one more rate hike this year, but now expects only 2 cuts in 2024. While some committee members raised their estimates for the long-run federal funds rate, the median expectation remained at 2.5%. This more hawkish outlook also stems from the Fed's expectations for a more resilient U.S. economy. In the September summary of economic projections, real GDP growth expectations has more than doubled for 2023 and rose for 2024. Elsewhere, a tick up in the median forecast for headlines PCE was met with a lower core PCE forecast, while the median forecast for the unemployment rate fell to 3.8% from 4.1%. Piecing this together, the Fed appears to be forecasting a soft landing scenario. However, with a number of headwinds facing the current economic expansion, the risk of over-tightening could challenge this outlook. The Fed is near, if not already, the end of its hiking cycle, which means investors are more interested in the potential for rate cuts as opposed to future rate hikes. If the economy avoids a recession, the Fed will be able to deliver mild cuts next year. However, if the U.S. economy enters a recession, the Fed may be forced to cut rates rapidly. Both outcomes, however, should bode well for high-quality fixed income investments. This slide shows 10 major asset classes and styles and their valuations expressed as Z-scores versus their respective 25-year history. Using z-scores allows us to illustrate how normal or abnormal current valuations are compared to history. Negative z-scores indicate the value lies below the average. Positive z-scores indicate the value lies above the average. Amidst the recent backup in yield, fixed income continues to look attractive as U.S. Treasuries, core bonds, and municipal bonds remain below their average valuation levels. International equities continue to trade at historical discounts, while some of the riskier segments of the U.S. market, specifically large cap equities, growth equities, and high yield bonds, are trading rich relative to history. As investors assess positioning for the remainder of the year, it is important to assess both the remaining risks on the horizon as well as the menu of investment opportunities after this year's market rally. Within equities, investors may want to lean into international markets and focus on finding attractively valued companies poised to drive long-run returns, diverting some focus away from the top few stocks that have driven this year's gains. The current opportunity presented in fixed income could pass rather quickly once the Fed begins lowering rates, and investors would be well served to take advantage of current yields. A surge among some of the largest tech stocks have driven strong gains in the S&P 500 so far this year. While this year's performance is a welcome rebound from last year's dismal returns, with the S&P now trading at nearly 17 times forward earnings, valuations are starting to look stretched and warrant some caution. That said, for active managers looking beneath the surface, there are still plenty of attractive opportunities. Page 7 of the guide shows a median price-to-earnings ratio of the S&P over time and the valuation spread between the most expensive fifth and the least expensive fifth of the index. As a result of the narrow breadth of this year's rally, the valuation spread is still setting well above average levels. This means that, while some stocks look expensive, there are still plenty of stocks trading at attractive valuations relative to the broader index. Environments like these are where a combination of passive and active management stands out. Investing passively may overweight some of this year's winners, and active management allows investors to lean into the undervalued segments of the market. It can't be stressed enough how concentrated the return on U.S. equities has been this year. The top 10 stocks are now contributing 97% of this year's 13% return of the S&P 500. The left-hand side illustrates how overvalued the top 10 companies are in green, even despite the correction of the past couple of months. The silver lining is the other 490 companies, the gray, don't have such excessive valuations. It gives a little bit of comfort that the market is not exuberant here, but it's not absolutely dirt cheap either. So investors need to have not only the guts to invest in the market, but also to think through what exactly to buy. Strong market performance, moderating inflation, and tight labor markets have allowed consumer sentiment to rebound after its trough in June of 2022. This summer saw a less gloomy consumer with strong sentiment gains in June and July. However, the fall is splashing some cold water on this exuberance with higher gasoline prices and the gradual pass-through of higher interest rates to borrowing costs likely weighing on sentiment going forward. When investors feel gloomy and worried about the outlook, their natural tendency is to sell risk assets. However, history suggests that trying to time markets in this way is a mistake. This slide shows consumer sentiment over the past 50 years with 9 distinct peaks and troughs and how much the S&P gained or lost in the 12 months following. On average, buying at a confidence peak returned 3.5%, while buying at a trough returned 24.1%. Importantly, this is not to suggest that U.S. stocks will return anything like 24% in the year ahead, as many other factors will determine that outcome. However, it does suggest that when planning for 2024 and beyond, investors should focus on fundamentals and valuations rather than how they feel about the world. At the end of last year, the global economy was losing steam, with only 27% of the countries shown on this slide registering a manufacturing PMI above 50, the level associated with accelerating economic momentum. Since then, Europe avoided an energy-induced recession, and China lifted its zero-COVID policy, raising the prospects for global growth momentum. That said, economic momentum in both the Eurozone and China have proven weaker than expected, leading to a more challenged global picture. In China, the lifting of COVID restrictions has allowed for a rebound in consumption after 3 years of suppressed services spending. However, subdued consumer confidence and business investment have led to a lackluster reopening, with the People's Bank of China recently enacting accommodative policies in an attempt to stimulate economic activity. That being said, the benefits of these policies have yet to be seen, and more aggressive action will likely be necessary. Such challenges have spilled over to Europe, where the growth outlook is weakening against a backdrop of still elevated inflation and manufacturer pessimism. In August, the Eurozone flash PMI came in at a 33-month low, with new orders for manufacturing coming in at one of the fastest rates since the financial crisis. However, there are still some bright spots. In India, cyclical and structural tailwinds have supported the economy and inspired investment enthusiasm. Importantly, India has a lower dependence on China, helping in part to explain the strong momentum the country is experiencing compared to other export-oriented Asian economies. Japan has also benefited from cyclical tailwinds, with increased tourism and exports supporting the country's current expansion. Moreover, corporate governance reforms and hotter wage growth are helping to create a more compelling investment story after 30 years of weak performance. With sluggish growth in Europe and China offsetting stronger growth from India and Japan, global activity may be challenged in the coming months. However, lower export prices from China could help the global fight against inflation, and a resumption in the dollar's decline should boost returns for U.S.-based investors. Moreover, there remain clear areas of investment opportunities. Emerging markets have performed better outside of China, and investors may find better entry points in technology in East Asian markets than in the U.S. This chart illustrates how U.S. equities dominated for 14.2 years prior to the regime change to non-U.S. developed markets, as measured by the MSCI EAFE. Non-U.S. equities are into a 1.9-year cycle of outperforming U.S. equities. A regime change is determined when cumulative outperformance peaks in one asset class and is not reached again in the subsequent 12-month period. This highlights the need for a well-diversified portfolio. This slide illustrates the currency effect by comparing the local return to the return in U.S. dollars. A portion of the return is derived from the exchange rate, which may be positive or negative. For example, the year-to-date return in local currency for Japan was 26.2%. However, when converted to U.S. dollars, the currency effect detracted from the return, meaning an 11.6% return in U.S. dollars. However, a U.S. dollar-denominated investor saw a 13% return in Brazil and only 7.1% in local currency. Again, non-U.S. equities provide much-needed diversification. And speaking of diversification, this slide shows annual returns going back 73 years for a 60% equity, 40% fixed income portfolio. There were only 13 years when the balanced portfolio return was less than zero, or 18% of the time. So far this year, the portfolio shows a 7% return. The positive component of this return can be attributed to equities in green, while there was a small detraction by fixed income in gray. However, in 2022, both equities and fixed income contributed to the 16% loss in portfolio value. And in 2020, both equities and fixed income contributed to a positive return of 14%. This reminds us to stay the course even when it feels like some investments in our portfolio are hard to hold. And to wrap up this quarter's review, we look at the matrix as of September 30th, 2023 year to date. U.S. large cap equities led the field with a 13.1% return, followed by developed market equities at 7.6%. Fixed income is down 1.2% because of the Fed's ongoing tightening approach. Real estate has been hit really hard this year as businesses grapple with how they're going to move forward in a post-pandemic world. This year has been one of those hard-to-hold asset classes as part of a well-diversified portfolio. There you have it, this quarter's economic and market review. Thank you very much for making it all the way through this quarter's review. As always, please feel free to reach out to me to review this and more.